So, very quick introduction to myself. My name is Arvind Purushotham. I co-head the venture investing team within Citi Ventures. And to begin with, what we'll do is we'll have the panelists introduce themselves briefly. We'll go through a set of questions, and about 4 o'clock or maybe a couple minutes after 4, we can stop and switch to some Q&A. So with that, why don't we just go down the line here. Simon, if you want to kick us off.
Sure. Hi, can you hear me? Hi, I'm Simon Yu. I'm the founder and managing partner of a relatively new VC firm called Green Visor Capital. We're one of the few that focuses on... Can you hear us okay? Is that better? Okay, thank you. Thank you. We're one of the few VC firms that focuses exclusively on FinTech. We also prefer to make our initial investments at the seed stage, oftentimes being the first institutional investors in the cap table. I have the good fortune of having some outstanding partners, probably the most famous of which includes Joe Saunders, the former chairman and CEO of Visa. Joe retired as chairman and CEO in April of 2013, and he helped me launch the team. And in addition to Joe, we have Sam Wen, who's one of the founding team members of Square, and also one of the gifted young engineers in the Valley. Sam's claim to fame, among other things, is he designed the hardware and software that powers Square today. Like I said, we've been around for 2 years, but we've invested already in 16 companies, and we have a couple of deals to be announced relatively soon. And it's a pleasure to be here. Thank you.
Thank you. Hi, Dana Stalder. I'm a partner at Matrix Partners. On the flip side, we're a relatively old venture capital firm, about 35 years old. Operate in the U.S. out of Boston and here in the Bay Area. We also have a team in India and in China. We are early stage investors, predominantly Series A, and all technology focused.
Hi everyone, my name is Colleen Poynton. I'm with Core Innovation Capital. We are also a relatively new venture capital firm. We're just starting our second fund. Fund 1 was launched in 2010. We're also exclusively focused on financial services and financial technology, with an explicit focus on companies that are driving outsized value for everyday Americans. So making financial products and services that are an order of magnitude more efficient for the end consumer. The fund was founded by our managing partner, Arvind, who has a long career in investing in financial services, starting in the early 2000s. He also founded what is now one of the largest think tanks focused on consumer finance here in the United States, called the Center for Financial Services Innovation. So they frequently put out really valuable research in the space and have very close kind of conversations with the regulatory entities on Capitol Hill to understand kind of what's at the cutting edge from a policy perspective. And yeah, we're interested in companies that are driving orders of magnitude improvements across the board in fintech and financial services.
Hi there, my name's Pat Grady. I'm a partner at Sequoia Capital. We've been around for about 40 years, and we really only do one thing, which is to try to help a small handful of founders make a dent in the universe. And we do that across stages, we do that across geographies, and we do that across sectors. Every now and then it actually works, and it produces companies like Google and Apple and Oracle, or LinkedIn, WhatsApp, and Airbnb. I personally spend most of my time in enterprise technology, but I also have a focus in financial technology.
Great. Thanks all. So I have a set of questions that we can run through. I'll throw it out to specific folks, but anybody feel free to jump in, and let's just make it conversational. To begin with, maybe Dana and Simon, you guys can take a stab at this. Financial services has been around for a long time, and for a long time the view was it's a tough sector for startups. It's not something that you can do typically with the kind of capital available from venture capital firms. But that's changed a lot. 2014, I think, was up 4x from 2013. And so why is it exciting now? What's changed from your point of view? I think Sasha in his presentation covered the why now question as well, but would love to hear your guys' perspective.
Sure, I missed Sasha's presentation, but from my perspective, a couple of things are going on. The first is the financial crisis of late 2008, 2009 was fundamentally changing for the financial service industry. A lot of innovation stopped. A lot of existing businesses were pulled from the market. And I think, and on top of that, there's an unprecedented level of regulatory and compliance burden that has been laid on top of the financial institutions in the United States. That has created an opportunity for an enormous amount of innovation. You put behind that the capital market cycle we're amidst with lots of venture capital and seed capital available, so it has created an enormous innovation cycle in the category that I think still has another decade to go here.
Simon.
Completely agree with all those points. I would add a handful more. First, you've seen the proliferation of smartphone technologies, which has lowered the cost of distribution, discovery of content, generally across a number of industries, but in particular within financial services. And if you look at even developing markets around the world, mobile phone penetration is at or above 100%, whereas banking penetration tends to be at or below 50%. And we think that mobile technologies could be a very, very important part of the financial services ecosystem going forward. In addition, more locally, I think there's a tremendous amount of lingering resentment among consumers for the fallout that occurred post-financial crisis. And then last but not least, I think for the first time, at least in my working career, and I've been around in financial services for over 25 years, you're seeing talent that's poachable from some of the top-tier financial institutions. I never would have guessed, for example, that Google would have hired Ruth Porat to be their CFO. But even levels below that, you're seeing people in their 30s and 40s who probably would not have left, you name the top-tier financial institution, but are now giving it a go within the startup community. That would have been very, very hard to do pre-crisis, given where compensation was, certainty of compensation in particular, at financial institutions.
No, that's great. And those answers bring up sort of the next question I wanted to ask, which was about regulation, right? That was one of the things that held VCs back from investing in some of these startups. Regulation, I think, has gone up since the 2008 timeframe. And yes, maybe when the startup is small, there's not that much oversight, but then that comes eventually. So does anybody want to address, like, how do you think about it? How do your partnerships think about regulation? I mean, you're all in lending businesses. You're in businesses that are heavily regulated. So,
yeah, I'm happy to speak to this. I think one of the most important characteristics we look for is an awareness among the founding team that this is a critical issue, and so that even if they're small and early and the regulators are, they're not yet on the regulatory radar, this is something that from day one you have to take extremely seriously and proactively seek out feedback and a dialogue. I was actually just recently in Washington, D.C., and had the chance to hear from a wide array of regulatory entities. And from their perspective, just dialogue is one of the most important things, right? Like transparency and openness, so that there's a sense of kind of mutual respect and you get on the right side very early on. So that said, I think that clearly you need to have a compliance regime that is appropriate to the stage of maturity of the company. So seed stage companies are not going to have compliance officers, obviously. But part of the value that we bring, and I'm sure all of the funds here bring, to an investment is bringing kind of a more seasoned regulatory perspective. We understand what flags to look for, where a company might be out of line with compliance, whether it's on TILA or FCRA or UDAP. And we work with specialists who just do this all day, every day, so that where we're not smart enough, they can step in and say something may be an issue. So we just try to make it kind of a proactive part of the conversation very early on. And then try to connect the companies that we work with to the right resources so that they can do that efficiently. And then the one other thing I would add is just you're seeing really interesting opportunities for partnerships. So banks providing kind of some of the back end to various consumer-facing fintech companies and absorbing some of that kind of compliance overhead. Similarly with money transfer licensing and some partnerships we're seeing in payments, there's an opportunity to have a little bit of regulatory arbitrage through the partners in your supply chain.
Pat?
Yeah, so I agree with everything you said. We actually have a little bit of a different view on it as a partnership, though, in terms of our role. So I guess first I'd say we have a kind of inherent faith, and probably naively so, but it's served us well in the past. We sort of have an inherent faith that the regulatory regime will eventually favor companies that have a solid value proposition that actually makes life better for consumers. And those are the only sort of companies that we want to invest in, right? Like, life's too short to invest in something that is not a net positive for the world at large. And so if we believe in a company and if we believe in the value proposition of the product that they're selling, we actually don't worry too much about regulatory. Because when you're a startup and the whole world is already against you, you're trying to create something out of nothing, regulatory is the sort of thing that you have the luxury of thinking about far down the line. At time zero, you just better hire some super smart people and create a killer product and figure out how to get it in your customers' hands so that you can then have the luxury of thinking about regulatory later. Now, that being said, we're not completely blind to it. And so if you look at like Prosper Marketplace as one example, the first outside director who joined the board was Raj Date, who used to run the CFPB. And so we do try to help connect the companies that we're working with to people who do understand regulatory to a much greater depth than we do. But at Sequoia, we will never be good at understanding the regulatory environment, but hopefully we can connect people to those who will be.
That's very helpful, but let me ask it this way, right? Like, are there companies that you would not touch because of regulatory reasons? Like, are there areas that you just think, even with sort of the entrepreneurs with the right mindset and enough capital and all that, is still a very tough area?
I mean, the answer may be yes if we explored all the possibilities. But I'd say in general we don't have any hands-off categories. We're very focused on innovation and change and kind of the output. And I think the other way to think about regulation cuts two ways. It is, while it's a barrier to entry, it also creates a big moat of defensibility. So that is actually appealing for us as investors. Where if you can put capital to work in a business and create a big moat, that gives you time and big competitive advantage.
If I could just add to what Pat said earlier, we think of it in a similar way as well. We want to back socially responsible companies, right? And we don't want to back technologies that, while it can generate near-term profits, at the end of the day, given how quickly information can spread in this world, if you've built your business on some shady fundamentals that ultimately get discovered. So one of the first cuts when we look at business plans is the technology being used to solve what we would refer to as a substantive issue, and are the founders building socially responsible companies? Because the temptation in the short term can overwhelm people if you're not careful. So we're very, very judicious in that approach. The other thing I would add too is, and it depends on, I think, cultural backgrounds, but in the U.S., you tend to find entrepreneurs that look for regulatory arbitrage and look for ways in which they can get as close to the line as possible without necessarily overstepping it. And the business ethic in the United States is, as long as you follow the rules to its entirety, you should be okay. But the rest of the world, I think, views legal contracts a little bit differently, which is principles-based approach. So it's the spirit that matters just as much as the actual letter of the law. And time again, traditional financial institutions, I think, seem to get that wrong. And if you look at what's been imposed upon financial institutions, traditional financial institutions, it's been profound. The tally, I believe, just for the top 12 largest banks in the U.S. and the top 6 largest European banks is something on the order of $200 billion worth of regulatory fines, post-financial crisis. So I think we encourage all entrepreneurs to think very, very carefully about it, because it will catch up with you sooner rather than later.
Fair enough. So maybe Colleen and Simon, maybe you could take a crack at this next one, right? I'm at a large traditional financial institution, and one of the refrains we hear from a lot of the big guys is, hey, the products and services that these startups are offering, it's just a pretty UI. It's about the technology, it's about mobile. There's really not a whole lot of depth beyond that, because after all, they're going off of other people's pipes and other people's licenses. What do you say to that? I mean, how do you think about it, especially, Simon and Colleen, you guys focus on financial services. Would love to hear your thoughts on that.
Sure. So I think fortunately for all of us, there's a lot more innovation going on than just the skin, the UI UX. That's important, right? Like good product design is critical. It influences the way the consumers engage with your product or service. But I think there's a lot going on at a very fundamental level. So this could go in many directions, but one example or one kind of broad trend maybe to touch on is what we've seen as shift from financial services being fairly blunt and unpersonal and sort of one-size-fits-all to much more dynamic and much more highly personalized, i.e. products and services that more accurately reflect the individual and the circumstances that they are serving, and that can even potentially adapt and adjust as that individual's financial circumstances change. And so that is something that's quite fundamental, and it's being driven by, I think, first of all, access to sources of information, connectivity between people, assets, accounts, and service delivery, and then much more sophisticated ways to analyze and pull all of that information together. So this is being manifested in much better pricing of risk and credit. It's being manifested in terms of much more smart dynamic savings and investment tools that can shift with you. It's being manifested even in areas like insurance, where you see dynamic insurance plans that now adjust based upon the state of a certain asset, or the state that the user is in, who owns the asset, or can be bought on kind of a use-by-use basis, right? So this is like a much more flexible financial services than existed even 5 or 10 years ago, and a lot of it is enabled by underlying shifts in the pipes, in the data, and in the analysis that we think is much more substantive.
I agree with that. I would also add, the smartest incumbents have already embraced startups and are partnering or investing in wherever they can, whenever it makes sense.
And Capital One and others have bought
no
companies
doubt.
that are specialists in UI.
So, the UI is obviously very important because the user experience, especially when you're, when you have a retail-focused product, is absolutely critical to getting that first set of customers to build scale. But I think something fundamentally deeper is happening now, and I would like to draw a historical analogy. I mean, when you look about automation early on and go back, I don't know how many people have read Walter Isaacson's book called The Innovators. It's absolutely fascinating. I don't know how many people here know Herman Hollerith. Anybody know who he is? Right. Okay. Kudos to you if you do. He invented, or he created an innovation using punch cards. He was a census taker. And in 1880, when the census was taken, it took 8 years to tabulate the results by hand of that census. You realize that was idiotic. And so through punch card innovations, for the next census, he brought that time down to a year. And his company became the predecessor to IBM. And I think what we've seen in the last iteration of financial technologies, or many different technology companies, is that brute force sort of computational speed has been brought down by many orders of magnitude. But what you're seeing next is something much more artful happening. And if you think about how the digitization of financial services is evolving, it's that highly prized, very expensively produced intellectual content that underpins investment banking, equity research, asset management, and the like. That is soon going to be replaced by code, in my view. So one of our biggest LPs happens to be an information services company. They have thousands of people on staff who do nothing other than collect data, input the data. But the code that's being produced by some outstanding entrepreneurs in this space, I think, could replicate all of that very, very quickly. And I think we're actually much further along than people realize in that regard.
I'm going to add one other thing that occurs to me listening to this and thinking about the question, which is, I think one of the other issues the top FIs in the world have is their brand, the relationship they have with their customer, consumer of today. The reality is there's been a a lot of consolidation in this industry. That's enormous profits. You know, one of my favorite stats is U.S. retail banks will generate $30 billion of overdraft fees on checking accounts this year. Right? I think, and I'm sure this shows up in the brand work that Citi and all the other big banks look at, right? Which is there is a brand challenge they have with their relationship with consumers today, and I think that's amplified with the millennial generation. So, and that's part of why I think just one of the other reasons that innovation, it's more than UI. It's in why consumers are so much more open to point solutions and new innovations in the financial service industry.
Got it. So switching gears a little bit, I think Simon and Pat, it'd be great to get your take on it, especially since, Simon, you were at a bank. You were at Citi in the past.
Please don't hold that against me. Actually, I love my time there. Thank you.
If you were building a bank today from scratch, what would it look like, right? And people have taken cracks at it. Simple comes to mind, Number 26 over in Europe, Fedor, Movin, etc. Have you guys looked at companies like this? What do you think about their approach? I mean, it's sort of related to the whole UI, UX issue.
Sure. Well, Dana said it before. You know, traditional institutions face so much in terms of regulatory adherence requirements. For those of you who haven't already, I encourage everybody in this room to read Jamie Dimon's letter to shareholders. I mean, it's fascinating because he talks about, and with a great deal of pride, just how much he's done to meet all the different regulatory regimes, both here and abroad, and the number of man hours committed to each one of these regimes that he has to meet. And last but not least, he's added something like 8,000 compliance professionals in the last year. Right? Fully loaded, that's probably $4 or $5 billion of top-line expense just to meet regulatory requirements around the world. Right? So that presents an enormous opportunity. And as Dana was also saying about, you know, the bigger institutions, because their infrastructure is so large, because their distribution oftentimes is predicated on, you know, brick and mortar, although that's changing. You know, they've made a conscious effort to go after the biggest fee wallets, whether you're talking about retail or corporate or institutional. By design, they are focused on much larger types of clients, which leaves a whole swath of customers that are underbanked, right? So then, as I was saying before, how do you promote inclusion in financial services? How do you do that in a way that's cost effective, right? You know, it doesn't work if, you know, you're trying to service a customer that only may generate, you know, X numbers of dollars in lifetime value if you're trying to do it the traditional way. And so I think at the heart of it all, the proliferation of smartphones is going to be the basis on which a lot of different businesses will be built, right? We're already seeing examples of that today, but I think we're just getting started. And I think the telcos are just waking up to that possibility. And I'm sure everybody here is familiar with Bitcoin. And as exciting a breakthrough as the blockchain is, it's dwarfed in comparison by even simple technologies like M-Pesa. Is everybody here familiar with M-Pesa? Right. For those of you who don't know, it's only been around for 5 years. It was formed in part by Safaricom and Vodafone, I believe. And it's become the de facto transactional platform and currency for Kenya. You know, in a country that, and not to speak disparagingly of the country, but in a country where there's only one toilet for every 200, 250 people, there's one telephone or cell phone now for every 2 people. And now, fully a third of the GDP of Kenya is transacted on this very simple text, you know, sort of money, which is, by the way, supported by the regulator, and all those digital assets are backed by actual dollars in the banking system. Right.
It's very helpful. And Pat, would love to hear your thoughts as well. And one of the things I noticed is you actually backed and worked with First Republican Bank. Very successful bank, but antithetical to a lot of the mobile-only types of banks out there. So would love to hear your views on it.
Yeah, so First Republic actually fits pretty neatly into what we think the bank of the future is going to look like. And I'll comment on the bank of the future, and then I'll comment on how First Republic fits in. So we don't know exactly what it's going to look like, but we do have a couple of things that we're fairly sure will be first principles associated with that bank. So the first one would be, if you look at banking historically, it tends to be divided up into different products, and then you try to shove as many of those products as possible down the throat of your customer. So said differently, it's very kind of balance sheet centric, very product centric. You know, you think, what do I have? And then you try to figure out how you can foist that upon your customer. So the bank of the future, by comparison, is going to be extremely customer centric. It's going to exist where the customers are, which is why mobile is important, which is why social is important. But it's going to begin with the customer and then delicately suggest things that the customer might want in a way that is much more elegant and welcome than what we've seen from the banks thus far. And that's actually the reason that we were excited to invest in First Republic Bank, because I think it is the single most customer-centric bank in the United States. And I think the growth that they've had and the way that they operate their business is a testament to that. So that's principle number one. Principle number two, and this goes down to, okay, well, what does it take to create a consumer-centric bank? It takes an incredibly flexible technology stack. The bank of the future will be a technology company. It will have a fully microservices architecture where each of the core competencies of a bank, credit, risk, regulatory, marketing, funding, everything will be packaged up into an API that's accessible to a set of developers who will be fully focused on the end customer specifically, which will enable a level of iteration that actually allows you to build your product around the customer, as opposed to, like Colleen was saying, having the one-size-fits-all product and then trying to shove it down their throat. And so we think it'll be very API-driven, it'll be microservices architecture, it will be able to iterate at a pace we've never seen before in financial services. Obviously, that's going to require some regulatory changes, but we think those will come eventually as well. And then I guess the third thing I'd say, anyone who opens up shop and says, we're the bank of the future, immediately fails. The bank of the future will not begin by saying, we are the bank of the future. And there are two reasons for that. One is, nobody sets out to find a bank. People set out to find a checking account or a mortgage or some other specific product, but nobody just says, it's time to go find a new bank. And secondly, trust is so fundamental to the entire financial services industry. Anybody who aspires to immediately be a bank from day one is going to have an incredible amount of adverse selection bias. You're only going to get the people who couldn't be banked elsewhere. And maybe those people need to be banked, and maybe eventually they will be great customers for your bank. But on day one, to open up shop and say we're a bank is the wrong way to go. You have to start with a point product and earn your way into being a bank through exceptional customer experience over a very long period of time.
Well said. And to the last panel, if you think about what SoFi is doing, and they started with student loans, and they're saying we're offering mortgages and personal loans, and then in the future other products and services. To your point, they're building that bank without necessarily starting out saying, okay, I want to build a bank, right? So good point. I guess, show of hands, which of you guys has an investment, or your firms has an investment in virtual currencies? All right, Colleen, so you're the winner. So let's talk about, talk a little bit about your thesis, and talk about your investment, talk about the thesis and how you guys think about virtual currencies.
Yeah, absolutely. So we're invested in a company called Ripple Labs. So Ripple is similar in many ways to blockchain technology. There's some fundamental differences in the architecture of the protocol, and I think what differentiated Ripple, especially at the time of our investment, and one of the things that kind of drove our thesis behind that investment, was the realization that this technology was extremely powerful, but a direct consumer-centric approach was not sort of the near-term, likely highest and best used case in terms of thinking about where the greatest frictions, the greatest inefficiencies, and the greatest opportunity to create significant value. Because where those pools are is where you can get a wedge with what is a very novel technology, right? And so Ripple very early on had insight into this concept of using digital currency not as an asset, but as a rail for which to move value internationally at much greater efficiency, and basically to enable bank-to-bank gross settlement and clearance in T plus 60 seconds versus T plus 3 days or more. And so when they looked at the ecosystem, they said, where can we really add value? Well, how about the amount of liquidity and capital that is locked up in the float of the correspondent banking system around the world? What does it do for the balance sheets of banks when that can be deployed into credit or a much higher yielding product than sitting locked up in a counterparty account somewhere? So that was kind of the go-to-market strategy. And in terms of our investment in it, given that we are a fund that is extremely interested in driving value for the end consumer, our thesis is that by changing the fundamental infrastructure, that creates a platform that's highly, highly liquid that then developers, much smaller companies can build on top of. But if you don't have that fundamental liquidity in place and you don't have sort of the balance sheets of the world at the table, it's going to be really hard for this technology to be anything more than kind of a hobby interest for folks that think this is really interesting or have kind of an ideological point of view around the value of the currency in kind of in other capacities. So that drove, I think, our interest in investment in Ripple, and I think it's been validated. We've seen a lot of innovation from other entrepreneurs kind of coming to the table, approaching digital currency with that respect, and now we're seeing, I think, some very interesting experimentation in the capital market space. There was a panel earlier, and it was discussed extensively. Obviously, looking at securities issuance, moving to kind of a digital ledger. And then another area, obviously, being remittance. So, I think there's a lot of opportunity when we look at the space and ask, like, what is the future? It's hard to predict what I think the next big use case will be. I think absolutely bank-to-bank or settlement and clearance, international money transfer, absolutely. And then secondarily, I think, where are there areas where you would benefit immensely from taking essentially siloed databases and unifying them and making them highly auditable. Because that is effectively what a ledger, a distributed ledger, whether it's a blockchain or the Ripple protocol, that's what it achieves. And so one area that I personally think is fascinating, this might be like a decade away, is thinking about the health system here in the United States, and what would it mean when you had medical claims and billings settled on an auditable ledger, and that you could associate very detailed meta information with each transaction. So you had a hybrid of kind of our medical payment system with our electronic medical record system and the kind of efficiencies that would drive in our healthcare system. So that's one particular area that I'm quite interested in, but maybe a little while out.
That's excellent. Actually, out of 4 panelists, it's surprising, right? Just one of the panelists has a blockchain or a virtual currency investment. What about the others? I mean, turns out we at Citi Ventures just made our first blockchain investment in a company called Chain.com, but would love to hear from the others as well.
Yeah, so we're actively looking at Bitcoin and blockchain, and I actually want to build on what Colleen said because I think she really nailed it in terms of the potential of the technology. And if you focus on should this exist, there are very compelling reasons why it should. And when I say exist, I mean at massive scale. Will it become the default, right? I think the first reason why it should is what Colleen said, which is it presents a whole separate set of rails that can be far more efficient in terms of cost and time than the existing financial system. I think the second reason it should exist is if you just zoom out and say, well, what's the function of currency to begin with? Medium of exchange, store of value. Ultimately, what sits beneath that is trust, and historically that trust has resided in sovereign entities who are kind of by default the holders of trust. But now we've got 190 of those across the world in a very globalized economy, and all of a sudden there's massive fragmentation of this trust captured in entities, each of which has their own agenda. Blockchain does not have an agenda. Blockchain also is a distributed system, which is inherently more resilient than any single point of failure, which is what we have in every single sovereign that issues currency. And so from a theoretical perspective, it absolutely should exist at massive scale in the future. Now the question on will it exist, this is the reason we haven't made an investment. And this is what comes down to what is the killer app for Bitcoin or what is the killer app for blockchain. We know that it's certainly not black markets, right? It's not speculation. It probably is some of the things that Colleen mentioned. And we're sort of waiting for the founder who comes into our office and sets our hair on fire with such a compelling vision, not only for the future, but for the path from point A to point B. That's what we're waiting for before we make an investment in the category. Because God forbid we theorize on what that's going to look like and then try to project that onto some founder. We want to hear it from the founder.
Well said. Fair enough. Just watching the clock here, I think we have about 5 minutes and would love to take some questions from the audience.
Thank you. A couple of times you mentioned more than UI, UX. Lately, there are a bunch of startups in automating financial planning. I'm surprised that there's nobody from that industry at this panel. But I wanted to hear more about what you mean by more than UI, UX. I gave one example. Maybe it'll succeed, maybe it won't. But would you like to expand on that example or some others?
Well, go ahead. I'm sorry.
I'll respond to that. So as I was saying before, I think there's some really interesting, and I would call it artistry, being done with code today, replicating what historically had been done by human analysts. And one of our companies is called Fiscal Note, and what they do is they track 10 million pieces of legislation at the city, state, and federal level, soon to do it on a global basis. They just launched a regulatory product that does the same thing. And if you go back to the example that I gave earlier about JP Morgan and Jamie Dimon hiring 8,000 compliance professionals, it is impossible for a single individual to keep tabs on all the different regulatory requirements. And the possibility of a misstep in the world of the big financial institutions will cost you hundreds of millions of dollars in regulatory action at a minimum, probably a pretty significant hit to your reputation and to your market cap. And so this is something really, really important. And it is impossible to do with humans. And so that's where I go to something much deeper. In Fiscal Note's case, they're able to take extraordinary amounts of unstructured information across a number of disparate sites, boil it all down, and then get very precise around who's sponsoring bills and who's sponsoring the regulations and how those sponsors interact with each other and who their underlying supporters are in their constituencies. That's a game changer in our view. So it's not just about pretty user interface. By the way, they have one. It's intuitive, and you can use it on your iPhone if you wanted to. So just an example.
Right, I think we actually only had time for that question. Thank you so much. Give it up to the panel. Thank you.